everyone, this is Tax Talks. You've been hearing the term of standard deductions and itemized deduction during your tax filing. What is this? Let's find out. Standard deduction or itemized deductions allows you to trim down your taxable income when you figure out how much you own in income taxes. Standard deduction is a flat amount set by the government, depends on your filing status. It's like a tax break that offsets your total taxable income. In 2023, the standard deduction for a married couple filing jointly is $27,700. Single taxpayers or married individuals filing separately is $13,850, and for heads of households is $20,800. Taxpayers who age 65 and older or blind can get an extra deduction of $1,850. Now, what are the itemized deduction? Itemized deduction encompass eligible personal expenses incurred during the tax year, serving to lower taxable income further. They are included in Schedule A itemized deduction that attach to your tax form 1040. Common itemized deduction include medical expenses, state and local tax, mortgage interest, investment expense, charitable contributions, casualty and theft losses, and other miscellaneous deductions. Regarding medical and dental expenses, you can deduct qualified expenses that exceed 7.5% of your adjusted gross income, or we call it AGI. For instance, if your AGI is $70,000 a year and you pay $8,000 on medical and dental expenses, you can claim $2,750 as the itemized deductions. For state and local taxes, you can itemize either income or sales taxes along with real estate and personal property taxes. However, there's a cap of $10,000 or $5,000 if you married filing separately on the total tax deductions. For mortgage interests, deduct interest paid on loans secured by your primary or secondary home. For loan taken out before December 15, 2017, you can deduct interest on up to $1 million or $500,000 if you married filing separately. And for loan after that day, the limit reduced to $750,000 or $375,000 if you married filing separately. Charitable contributions or the gift to qualified charitable organization can be deducted, but it's limited to 60% of your contribution basis or AGI. Any excess on that amount can be carried forward for up to 5 years. Regarding the casualty or theft losses, you can deduct personal casualty and theft losses due to federal declared disaster as well. This itemized deduction item lists above recorded in Schedule A to give you a total amount that you itemize for the tax year. If your itemized deductions surpass your standard deductions, it's financially advantageous to itemize them. However, if your standard deduction exceeds your total itemized deduction, taking the standard deduction may save time. In certain situations, itemizing your deductions is needed. For instance, if you're filing separately and your spouse is itemizing, when you're filing for tax periods that less than 12 months, if you are non-residents or dual status aliens, or when you're filing as an estate, trust fund, or partnerships. It is important to assess what deduction will benefit you the most, particularly in case where you have significant unreimbursed medical expenses, have paid mortgage interest or real property taxes, experience substantial unreimbursed casualty or theft losses from federally declared disaster, or make significant charitable contribution to qualified organizations. If you enjoyed the video, don't forget to give that thumbs up, make sure you hit the subscribe button, and stay tuned for more. Bye now!